We're up 70% from the low in December. And the economy just doesn't pivot like that. It doesn't change that dramatically. So we think it's all due to the Fed, or at least 90% of this turnaround is due to the fact that the stock market thinks they own the Fed, that the Fed can't do anything now and is sidelined forever, which frankly has us a bit concerned, because I think that's a lot of overconfidence built into the stock market right now.
Dom, but to Bryce's point, though, it's not as if the outlook for the U.S. economy got so dramatically worse to warrant the sell-off that we saw in the fourth quarter. So there's a couple different things going on.
Oh, no, there's absolutely a tug of war right now between bulls and bears because of that. And the V-shaped recovery that we got out of the markets is probably indicative of why people thought that the entire action that happened October, November, December of last year was quote unquote overdone. The issue is whether or not you see those catalysts. I mean, Bryce brings up the Fed, obviously one of the big headline catalysts of the year. The earnings season is just about over. We're in that last stretch right now. Just about 3/4 of the S&P has reported. Earnings growth is still good for the fourth quarter of last year, but the expectations have been coming down for first quarter. So you've heard the term earnings recession thrown about quite a bit. It's probably a little bit too early to call an earnings recession. Still, though, as long as those concerns are there, you might see sentiment be a little bit more on the dampened side of things heading into this next quarter.
And Bryce, are you guys long equities then, or how are you positioning for the rest of the year?
Well, we still have plenty of growth stocks on the equity side of the business. On the bond side of the business, we're a little bit nervous, frankly. We're looking at the Fed continuing to reduce the balance sheet. That takes out $500 billion worth of demand this year alone. Even though they say the word flexible and everyone's like, oh, everything's going to be fine, they're really not changing that policy. On top of that, the Treasury is issuing another $1 trillion. So the government bond will get issued. There will be demand for government bonds, but where will that demand come from? It will pull money from stocks. It'll pull money from everywhere. And so that's where it's going to get choppy. And I do agree with the earnings assessment that you just talked about, but this overriding headwind month after month, there's $125 billion that's got to come from somewhere to feed this beast that's the government bond market.
Yeah, and Bryce, it's interesting just to hear the cautiousness that you feel about owning bonds, because people have gotten more comfortable. They've said, you know what, interest rates aren't going to go up that much anymore, and so we're happy to kind of hang on to fixed income. But you feel differently.
Yeah, well, we like the tips, actually, because tip bonds were up today when traditional treasuries were down, even though this inflation report looked very, very mild. But the tips were building in an inflation rate of 1.8. I mean, there aren't any inflation measures that are that low. So within the bond market, we do think Treasury tips do offer a little bit of an advantage right now.
All right. So, Dom, there's still some hawkish people out there.
There are. Apparently, we are going to grow and have higher prices.
Yeah. We'll see. Bryce, we'd like it if it comes from better growth. Thank you so much for joining us.